You know, Brandon, my second favorite baseball player of all time was the New York Yankees great Yogi Berra. As many of you know, Yogi was known for his funny and interesting sayings. They were called yogiisms. A yogiism is a funny expression that lacks logic. I think that today's volatile and illogical market environment connects pretty well with some of Yogi's illogical sayings. For example, you can observe a lot just by watching. Well, Brandon and I did some research that was based on making some observations and then watching what happened. We found some similarities between 1999 and 2000 compared to today. The similarities were more than what we could have ever imagined.
You know, another saying is, this is like deja vu all over again. And Tom, you'll be happy to know that I ran some calculations, and as it turns out, by the end of today's trading day, you'll have been in the investment management business for 10,958 market trading days.
Wow.
So I think it's safe to assume that you've experienced deja vu all over again multiple times.
Well, as a matter of fact, Brandon, I feel like I'm experiencing deja vu right now, all over again.
Another yogiism we're going to use is, it ain't over until it's over. This current volatile market environment is really not only dangerous for investors, but it's also one that is far from being over with.
On a serious note, this video and the information contained in it may be the most important piece that we've ever produced. Brandon and I just completed an in-depth study that uncovered some unique and concerning factors about the existing market environment. In fact, we uncovered one factor that has only happened on 2 prior occasions. One of those was 1999 to 2000, and the other was 2007 and 2008. Both periods concluded with substantial declines. We're going to follow 3 of Yogi's illogical sayings as a guide to better understand the current illogical market swings. And even more important, we'll help bring some logic to an illogical market environment.
So Tom, the first yogiism that we're going to be discussing today is you can observe a lot just by watching. And so when most people watch the stock markets or the US stock markets, they're really watching the Standard & Poor's 500, which is the S&P 500. And that's made up of the 500 largest US companies. And that index itself is market capitalization weighted.
Right, so market capitalization of a company would be measured by taking the total number of shares that are outstanding and multiplying that times the price per share. So the largest capitalized company within the S&P 500, which we call the market index, is Microsoft. And the capitalization of Microsoft makes up 6% of the S&P 500, one company. And to put that in perspective, Microsoft is bigger than basic materials, bigger than energy, bigger than real estate and utilities, any of those individual sectors. As a matter of fact, if you take the consumer staples sector, which includes companies like Walmart, Coke, Pepsi, Procter & Gamble, it's almost as big as that entire sector, and that's just one company.
Yeah, so I think it's pretty safe to assume that the S&P 500 is not designed to be an efficient portfolio. It's just designed to measure, how large some U.S. stocks are. And the 5 largest stocks in the S&P 500 are Microsoft, Apple, Amazon, Google, and Facebook. And collectively, those 5 stocks make up 22% of the S&P 500. So 22% of that index's performance comes from just 5 stocks.
Right.
They have a huge impact. And those 5 stocks are all considered basically technology and growth. They're all growth stocks. And so if we're looking at the NASDAQ 100, which pretty much has all growth stocks in it, and we compare that to the S&P 500 value stock index, well, the NASDAQ is actually up 20% year to date, whereas value is down 17%.
That's about a 40% spread between the NASDAQ and value stocks.
Yeah, and we mentioned that, the Nasdaq's mostly technology. Well, the S&P 500, broken down into 11 sectors, technology makes up 27% of the overall index. And that doesn't even include Amazon, Google, Facebook, or Netflix, which, Amazon's up 60 some odd percent this year, and so is Netflix.
Right, and they're all correlated to technology, which would, if we included those companies, that would make technology
About 38% of the S&P 500. So technology would make up 38% of the S&P 500. There's been only one other time when a sector has been, more than 35% of the index, and only one other time when the Nasdaq has had that large of a gap over value, and that was back in.
coming right into the year 2000.
Additionally, there's been only one other time when a sector has made up over 20% of the S&P 500, and that was financials back in 2007.
Right.
And we all know how both of those events ended.
Yeah, with the S&P 500 down 50%, and those two sectors were down well over 70%.
So based on this information, you can observe a lot just by watching, and that brings us to the question,
could this be deja vu all over again? Just a few short months ago, the S&P 500 dropped about 35% over 23 days, and then gained back half of the decline in only 18 days. The volatility of the S&P 500 had reached the highest level seen since the worst part of the 2008 financial crisis. The volatility was even higher than what we saw during the 2000 tech wreck. Would the market go back and retest its lows, or would it continue to go higher without looking back? For now, the S&P 500's gone higher because it's being carried on the shoulders of one dominant market sector, the rocket ship that has made a miraculous and unsustainable parabolic advance: large cap technology related stocks. Today's market environment is amazingly similar to what we saw at the turn of the millennium in 2000, and we all know how that ended. Brandon and I will show you some similarities between right now compared to the time that led up to the 2000 tech wreck. Could this be deja vu all over again?
So this is a chart spanning from July of 1998 up and through March the 24th of 2000. So the market is now at a peak right before the 2000 tech crash, the tech bubble. And the chart shows the S&P 500 versus the S&P value index. So there's probably 250 stocks, give or take, within that index. And you can see in this chart, the S&P is in black and the value is in blue. Well, the S&P is substantially outperforming value by about, 20 some odd percent there. And so, what that says is, well, growth is kind of carrying this market. And take that a step forward, we add the green line in, which is financials. Financials at the time, Tom, was the second largest sector within the S&P. Okay. And so what this is saying is, the second largest sector by a wide margin isn't performing nearly as well as the overall, S&P 500. So what's carrying the market at this time? And that would be technology. Now, keep in mind, this is the same chart time frame we just showed you, but technology is outperforming by that large of a pace, and most of it occurs in the last 3 months of this chart.
Wow. How much is it?
Yeah, so since, June the 30th of 1998, technology would have been up 160%. Again, 120% came in the last 3 months, as opposed to the overall market, which is up a little bit less than 40% over this time frame.
So, Brandon, that would be the definition of a
bubble. Yes.
A bubble. Now, we never know exactly when the bubble is going to pop. Mm-hmm. All we know is
bubbles do pop.
That it will pop.
So this chart picks up where the last one left off. So starting on 3/24/2000 and goes up through about 2.5 years later, up through 2002. And you can see here that the market, the black line, the S&P 500, fell by 48%. And Tom, financials, which in the previous chart had kind of lagged behind the overall S&P, only fell 12%. You know, it was the second largest sector, and it was pretty much the only place to be, and as a result, gained a bigger market share of the overall market. And then the blue line, the S&P 500 value index, fell by 35%. So that brings us to the question, you know, we mentioned technology was in a bubble. Well, what do you think carried the market downward?
Well, would it be technology?
Exactly.
Wow.
Technology was a bubble, that bubble popped, and the sector fell by 80%, causing the S&P to fall by 50%. And here we have an overall image. So we have the two charts combined into one, just showing the S&P 500 now in blue and technology or the NASDAQ in purple. You can see technology had that substantial parabolic run-up of about 160% and then fell by 80%, causing the market to have, you know, a really big bear market.
So again, Brandon, how long did it take to go up the 160%?
It went up 160%, a little bit under, 2 years, but most of that actually occurred in about 3 months.
In about 3 months. So that kind of a move is unsustainable. And we know that all parabolic advances like that end the same way.
Big pop and a big drop.
And a big drop, 80%. So now we'll come to the present, and we'll go from 2017 through today, and you will see some stark similarities between the period prior to 2000 up to 2000 and now. And first, I'd like to bring your attention to the blue line, which is the value index, and the purple line, which is the NASDAQ. And this looks very, very similar to what we saw coming into 2000. Value is substantially underperforming. High volatility is basically going nowhere. And then you compare that to the NASDAQ, which is now making up
38% of the overall market and really pulling the S&P 500 higher. And another thing to point out here is we haven't seen this large of a gap in performance between, the NASDAQ and the S&P value index since that bubble back in 2000. And if you look at the shape of that curve that the NASDAQ's going through, that's a parabolic advance.
Just like before.
That's a bubble. We don't know when bubbles will pop, but we do know that they do eventually pop, and that'll probably be sooner rather than later.
That kind of move is unsustainable. But, make no doubt about it, we are in a very risky market environment. So do not overly concern yourselves with missing out on any advances at this point, because as we've said before, this is really fake pricing. Give it a few weeks or a few months, it's going to look entirely different.
And Tom, our next section is called It Ain't Over Until It's Over.
Well, this definitely ain't over.
So the yogiism here, Tom, is it ain't over until it's over. So that brings the question, when is it actually going to be over?
Well, it ain't over until you leave this planet. I mean, investing is a lifelong endeavor, but between now and then, everything is real time. I mean, the markets trade on a real-time basis. The decisions that we make are on a real-time basis. We'll have some incredible opportunities over time. There'll be some periods like now that are highly risky. There'll be traps that we can fall in. But, there's no doubt about it. Right now is a highly risky period in the market. The market is like a loaded gun and the hammer is cocked. And the question is, should we put on the safety or just hope that it doesn't go off?
We just finished going over how, this market environment is eerily similar to the 2000s tech bubble. Today, technology and technology-related stocks make up about 35% of the S&P 500's market capitalization. That's almost identical to what it was back in 2000, and it's similar to what we saw with financials back in 2007, 2008. Both times, that market ended with substantial corrections.
Yeah, I mean, both sectors dropped between 70 and 80%. And since they were such a large component in the S&P 500, it brought the market down 50%. And, keep in mind, for a sector to be able to make up that much of the entire market, you've had a period of substantial outperformance, which means, again, as Brandon says, we've had this technology run that has become totally parabolic, and we all know how those are ultimately going to end.
Yeah, so if you're trying to benchmark a portfolio against an index that is heavily weighted towards a sector that is being exaggerated or on this parabolic advance.
You better strap on your helmet because investing is a lifelong endeavor, but there's any number of times when you can make one mistake, like in 2000 or 2008, and it can wreck your entire program.
So most people know how to put the safety on a loaded gun. You just take the gun, you flip the switch up, and there it is. But when it comes to the markets and when it comes to portfolio management, putting the safety on your portfolio during a difficult market environment is a much more complex process.
Yeah, it's generally not a good idea just to sell everything and go to cash. Actually, it's generally not a good idea to just try to move from one asset class to another, like move from stocks to bonds to cash and back again. That's actually market timing, and the risk is being in the wrong place at the wrong time. The Canterbury Portfolio Thermostat is pretty much fully invested all the time, and it uses software algorithms to adapt the diversification to be able to maintain stability through variable environments. And as you look at the chart, you'll be able to see that we've been pretty effective at getting that done over the last few months.
So this is our last chart for this video, and Tom and I want to make two quick points. So the first point is that most people think that the S&P 500 has been on a tear since coming off of its lows and it's putting in higher highs. And that's just not the case. You know, the NASDAQ is the only thing that's outperforming. NASDAQ is technology stocks. And because the S&P has such a heavy allocation to technology, it's being pulled higher. If we compare that to the gold line, which is an equal weight S&P, or even the dark blue line, which is a value index, which has very little technology in it, you can see that both of those indexes aren't performing nearly as well and have much more volatility.
The second point, as we've discussed several times before, volatility is a killer for financial assets because every decline requires a bigger advance to get back to break even. The objective of the portfolio thermostat is to be able to maintain stability and to limit the volatility. And you can very clearly see, since we stabilized the portfolio about 60 days ago, that we've been able to do that very successfully. If and when the market goes down, you would expect that same kind of basic pattern to occur into the future. As Yogi would say, making predictions is really hard, particularly when you're talking about the future. Now, I can't say for sure that we're going to see something like a 2000 and a 2008 all over again, but I can say that the characteristics are there for that to be able to happen. And that's why we chose to stabilize the portfolio over the last few months. It's going to take time for this to play out. But if and when it does happen, it's going to happen fast. It's going to occur probably over days and not months. And if you haven't made the adjustments, then you're probably not going to be able to. Now, we just touched on a little bit of the research that Brandon and I have done. If you'd like to get into a little bit more detail, please feel free to call either one of us, and we'd be happy to go over this with you.